For 2 years the market has obsessed over one kind of chip, the AI processor. NVIDIA, Broadcom, the names that tripled. But while everyone stared at the GPU, another whole category quietly collapsed, the analog and power chips that run your car, your factory, your power grid. One maker, Microchip, saw revenue fall 47% from peak. Here's my read, and it's the whole episode: that collapse was the setup, not the story. The cycle has turned, and last week it got confirmed. Texas Instruments, ticker TXN, just reported revenue up 23%, blew past its own guidance, and said next quarter will be bigger still. This is the recovery that happened while everyone looked away, and the market is still mispricing where the money is. So what are these chips? The world is analog: temperature, pressure, voltage, motion. Analog and power semiconductors sense the real world and manage electricity, converting power, regulating voltage, running motors and sensors. They're not glamorous. One might cost 50 cents. But a modern car holds hundreds, a factory thousands, and they almost never get designed out. Once your chip is in a car platform, it ships for a decade. That stickiness is why Texas Instruments and Analog Devices, ticker ADI, have long been among the most profitable, durable franchises in technology. They're the opposite of the AI boom: boring, broad, and wired into the physical economy. Now the crash, because you have to see how deep it went. In the 2021 shortage, customers panic-ordered and double-booked. Then demand normalized, they were drowning in inventory, and they stopped buying for almost 2 years. Microchip was the worst case. Revenue fell from a peak near $8.4 billion to $4.4 billion, a 47% collapse, with inventory at 266 days against a normal near 135. Onsemi posted 7 straight quarters of falling auto revenue. Here's the bifurcation: in 2025 the overall chip market grew 22% to $772 billion, almost all AI, logic, and memory, while analog went backwards. Because everyone watched AI, the analog winter happened in near silence. Here's why this is timely: the bottom isn't a forecast anymore, it's in the numbers. Texas Instruments just reported its second quarter, and it was a blowout. Revenue up 23% year-over-year to $5.5 billion, up 13% in a single quarter, led by industrial, automotive, and data center. Gross margin jumped to 61% from 58% a year ago. And it guided next quarter as high as $6.1 billion, an acceleration, not a peak. Analog Devices book-to-bill has crossed back above 1, orders arriving faster than it can ship. And Microchip, the most beaten-down name, swung to 35% growth. 3 months ago this looked like a turn. Now it's confirmed, and that inflection is the entire case. Let's put the field on the board. The two blue chips, Texas Instruments, the scale leader, and Analog Devices, the high-precision champion, both rare tech dividend aristocrats with over 20 straight years of increases. The turnaround: Microchip, deepest correction, sharpest rebound. The auto plays, NXP and onsemi, though onsemi just made a move that changes what it is. The AI exception: Monolithic Power. Plus the smaller names: Allegro, Power Integrations, Diodes, Vishay. If you've followed this run, homebuilders, insurance, distributors, trucking, AI connectors, now the chip cycle nobody's watching, subscribe and stick around. Same depth, every industry. Now let's break them down. Start with the giant, and the name at the center of my read, Texas Instruments, about $280 billion of market value, and in its just reported quarter, revenue up 23%, a 61% gross margin, and $6.5 billion in free cash flow over the trailing year. What makes it fascinating is a deliberately counter-cyclical bet. While the industry was down, it poured money into new 300mm wafer factories on U.S. soil, over $60 billion across 7 fabs, backed by CHIPS Act money and tax credits. Those wafers make roughly twice the chips at 20 to 30% lower cost. The bet: build the world's cheapest capacity during the bust, then own the margins in the boom. That spending crushed cash flow at the bottom, but capex is now stepping down, and you can already see the payoff in that 61% margin. Analog Devices is the quality play. $11 billion in revenue, gross margins near 70%, and a machine that turns well over a third of every sales dollar into free cash. Its specialty is high-precision analog, the hardest chips to design and to copy, used in medical devices, aerospace, factory automation, and increasingly AI data center power. Last year it returned 96% of free cash flow to shareholders, between buybacks and a dividend raised for 22 straight years. The thesis is clean. As orders normalize on top of that book-to-bill turning positive, free cash flow per share climbs, the durable compounding income investors prize. Less explosive than the turnarounds, but the highest quality way to own the cycle. Microchip is the highest risk, highest drama name. It fell the hardest and nearly broke. The fix came from a familiar face. Steve Sanghi, the veteran who built the company over 30 years, came out of retirement to run it again. His plan is brutal and simple: close a factory to save $90 million a year, cut roughly 10% of staff, slash inventory, pay down debt. Notice the contrast: where Texas Instruments is building fabs, Microchip suspended its CHIPS Act application and went asset-light. Two opposite strategies into the same recovery. And it's working: 35% growth and an all-time high stock. The deepest hole produced the sharpest bounce, but the debt makes it the riskiest seat in the group. Now the automotive angle, and the biggest strategic move in the group. The insight: car sales are flat, but chips per car keep rising. Every step toward electric drivetrains, driver assistance, and software-defined vehicles stuffs more silicon into each car. NXP calls it a content play: fewer cars, but each needs more processors. Onsemi is the power and silicon carbide specialist, and in June it did something telling. It agreed to acquire Synaptics for $7 billion in stock, bolting on an edge AI compute and connectivity franchise to push beyond power into what it calls physical AI, intelligence embedded in machines. Read that carefully. Onsemi is paying up to buy its way into the AI story. Which sets up the one name that grew into that story on its own. That name is Monolithic Power. While its peers collapsed, it compounded, because it makes the power management chips that sit on NVIDIA's GPU boards. As each AI chip's power draw climbed from 300 watts toward 700 and beyond, the power silicon per rack exploded. The result: Monolithic Power's enterprise data revenue grew 98% in a single quarter, nearly doubling, and now makes up about a third of the company. It just raised its long-term revenue target from $4 billion to $6 billion. Here's the contrast that matters: Onsemi is spending $7 billion to acquire an AI angle, Monolithic Power already had one. But it's also the priciest name in the group, valued for that growth to continue. The cheap recovery is in the boring names, the AI premium is right here. Let's be honest about what could break this. First, recession. Analog demand rides on factories and cars, the most cyclical end markets, so a downturn could stall the recovery before it builds. Second, Texas Instruments bet, $60 billion of fabs assumes demand recovers strongly. If AI soaks up all the growth and general-purpose chips disappoint, that capacity becomes a costly overhang. Third, China. Domestic makers are flooding the commodity end of analog and power, pressuring prices and qualifying into Chinese EV platforms that used to buy Western. Fourth, execution. onsemi-Synaptics deal is all stock, doesn't close until mid-2027, and big chip mergers often disappoint. The debate isn't whether the cycle is turning, it's whether this is a durable upcycle or just a restocking bounce. So here's my read. The turn is real and now confirmed, but the market is still mispricing where the value sits. It's paying a rich AI premium for Monolithic Power and cheering Onsemi for buying an AI story, while the cleanest, highest quality recovery hides in the boring blue chips. If I'm putting one name at the top of a watch list to express this turn, it's Texas Instruments, not the flashiest, but the only one harvesting a $60 billion countercyclical bet at the exact moment the cycle confirms, margins already back to 61% and capex rolling over. The risk was taken years ago, the payoff is arriving now. Analog devices is the lower volatility way to own the same thing. This is a lens, not advice. My prediction: around 60% odds this is a durable upcycle, not a one-quarter restock, with Texas Instruments free cash flow per share clearing $8 by the end of 2027 as fab spending winds down. So what do you watch? 3 signals, each a line in the sand. 1. Book-to-bill across Texas Instruments, analog devices, and Onsemi. It must stay above 1, slip below, and this was a head fake. 2. Texas Instruments free cash flow per share, it should climb toward $8. If it stalls, the fab bet isn't paying off. 3. Automotive revenue at NXP and onsemi, sustained gains confirm the content story. And what would change my mind? If Texas Instruments cuts the guidance it just raised, or book-to-bill rolls back under 1, I'd call this a restock, not a recovery. The best time to look at a cyclical business is when everyone else is looking elsewhere. For 2 years the market chased AI chips while the analog names bled out. Now the orders are back, the margins are inflecting, and the strongest franchise in the business is harvesting a bet it placed at the bottom. The AI chips get the headlines. The boring chips that run the physical world might get the next leg. I'm Big Z, follow me, see you in the next deep dive.